Welcome back to Smart Dollar Mindset, the channel where we help you achieve financial freedom with smart money habits and investing. Today's topic is a question millions of people face. Should you keep your money in a traditional bank or join a credit union? Which one is actually better for your financial future? This isn't just about where you cash your paycheck. The choice between a bank and a credit union can affect your savings, loan interest rates, fees, and even how much financial freedom you can build over time. In this video, we're going to break it all down. We'll compare banks and credit unions side by side, step by step. We'll talk about their differences, advantages, disadvantages, and the hidden details most people never consider. We'll also share real-life examples of how people saved, or lost, thousands of dollars depending on which institution they chose. Stick around until the end, because I'll give you a clear framework to decide which is better for you. Step 1. Understanding the basics before comparing. Let's define what banks and credit unions actually are. Banks are for-profit institutions. Their main goal is to make money for their shareholders. They make profits through fees, interest on loans, and financial services. Credit unions are non-profit cooperatives. They're owned by their members, people like you. Any profits they make are returned to members in the form of lower loan rates, higher savings rates, and fewer fees. That one difference, profit versus member focus, shapes everything else. Step 2. Accessibility and convenience. One of the biggest reasons people choose banks is convenience. Banks usually have nationwide or global branch networks, advanced online banking platforms, 24/7 customer service hotlines, large ATM networks. Credit unions, on the other hand, are often smaller and local. Some are tied to communities, jobs, or industries. While this used to mean limited access, things are changing. Many credit unions now partner in shared ATM networks, giving members access to thousands of ATMs across the country. Example, a big bank might have 20 branches in your city, while your credit union only has 3. But with shared networks, that credit union might give you access to 30,000 fee-free ATMs nationwide. So convenience isn't as one-sided as it once was. Step 3. Fees and costs. Banks make a lot of money from fees, maintenance fees, overdraft fees, wire transfer fees. Credit unions usually have lower or fewer fees. Why? Because they're not trying to maximize profits for shareholders. Example, a big bank might charge $15 per month unless you keep a $1,500 minimum balance. A credit union might offer free checking with no minimums. Over time, those savings add up. If you save $15 per month in fees, that's $180 a year. Over a decade, that's nearly $2,000, money you could invest instead of giving to a bank. Step 4. Interest rates on savings and loans. Here's where credit unions really shine. Savings rates. Credit unions typically pay higher interest on savings accounts and certificates of deposit. Loan rates. Credit unions usually offer lower rates on auto loans, personal loans, and mortgages. Banks, being profit-driven, usually offer lower savings rates and higher loan rates. Example, at a traditional bank, your savings account might pay 0.01%. At a credit union, you could earn 1.5%, 2.5%. If you're saving $10,000, that's the difference between earning $1 per year versus $200 per year. On the loan side, a 1 to 2% lower rate on a car loan can save you thousands over the life of the loan. Step 5. Customer service and relationship. Credit unions consistently rank higher in customer satisfaction than banks. Because they're smaller and member-owned, they often provide more personalized service. Banks, especially large ones, can feel impersonal. You're one of millions of customers. Example, if you fall on hard times, a credit union might work with you to adjust payments on a loan. A big bank might just send collections after 60 days. That difference in culture matters. Step 6. Technology and innovation. One area where banks usually win is technology. Big banks invest heavily in mobile apps, online tools, fraud detection systems, Zelle or instant transfers. Credit unions have improved, but many still lag behind. Some credit union apps look outdated or lack features you'd find at major banks. So if cutting-edge technology is a priority, banks often take the lead. Step 7. Eligibility and membership. Anyone can open an account at a bank. Credit unions, however, often require you to meet eligibility requirements, like living in a certain area, working for a certain employer, or being part of an affiliated organization. That said, many credit unions have broadened their membership rules. Some only require a small donation to a partner nonprofit to join. Step 8. Safety and insurance. Both banks and credit unions are safe for deposits. Banks are insured by the FDIC up to $250,000 per depositor. Credit unions are insured by the NCUA up to $250,000 per member. So from a safety standpoint, they're equal. Step 9. Real-life impact of your choice. Your choice isn't just about convenience or fees, it can impact your long-term financial goals. Example, Alex kept his checking account at a big bank and his auto loan at a credit union. Over 5 years, his credit union loan saved him $3,000 compared to what he would have paid at the bank. Another example, Maria valued convenience above all. She used her bank's mobile app to deposit checks instantly and transfer money internationally. For her lifestyle, the bank's technology outweighed the lower fees at the credit union. The lesson? It's not about which is best overall. It's about which is best for your priorities. Step 10. A hybrid approach. You don't have to choose one or the other exclusively. Many people use both. For example, keep a checking account at a big bank for nationwide access and a robust mobile app. Use a credit union for loans and savings to take advantage of better rates and lower fees. This strategy gives you the best of both worlds. Final thoughts. So, bank versus credit union. What's better? The truth is, it depends. If you value convenience, advanced technology, and widespread access, a bank might fit your lifestyle. But you'll likely pay more in fees and get less favorable rates. If you value lower costs, better loan rates, and personalized service, a credit union is often the better choice. But you might sacrifice some convenience and cutting-edge features. The real power comes from knowing what matters most to you and making a conscious decision. Because money isn't just about numbers, it's about how you live your life. Here's what I want you to take away. Banks are built to serve shareholders. Credit unions are built to serve members. And you get to choose which side you want to be on. But remember, you don't have to lock yourself into one box. You can use both strategically. You can have your paycheck go to a bank for easy bill pay while moving your savings to a credit union for better interest. You can borrow from a credit union while using a bank's technology for daily transactions. What matters most is that you stop drifting and start making intentional choices with your money. Because every dollar saved in fees, every percentage point cut in loan interest, every extra bit of interest earned on your savings, that's money that builds your financial freedom. At Smart Dollar Mindset, we believe financial freedom isn't about luck, it's about smart habits, informed choices, and long-term thinking. So ask yourself, do you want your money working harder for a corporation or working harder for you? Once you answer that, the choice between a bank and a credit union becomes clear. And if you found this video valuable, subscribe to Smart Dollar Mindset. We share strategies, insights, and practical steps to help you take control of your money, build wealth, and achieve financial freedom. Turn on notifications so you never miss a video that could change your financial life.